welcome. It's Friday, September 25th, and it has been quite the summer. But we're excited to be back and bringing you Conversations, a production of the Oakville Chamber of Commerce. My name is Tim Caddigan, and I'm pleased to be your host for this weekly series. Conversations is a current event show where we engage business, community, and political leaders and get their perspective on what is going on in the community and across the country and around the globe. Today, on our fall season premiere, I'm thrilled to be joined by Derek Burleton, Vice President and Deputy Chief Economist for the TD Bank Group. In his role, Derek leads a team of economists that provide leading analysis on the Canadian and U.S. economies. And as a respected commentator, Derek has been quoted by many media outlets, including the London Financial Times and The Economist. He's also frequently interviewed on the radio and on television, and again today on television. Derek maintains a strong interest in public policy issues and has written substantive reports on healthcare sustainability, education, and immigration reform. He participates in a number of advisory and steering committees, both internal and external to TD Bank Group, and currently serves as the board of the Toronto Association of Business Economists. Derek Burleton received his Bachelor of Commerce from Queen's University, a fine university, and a Master of Science in Economics from the London School of Economics. Derek has more than 20 years of experience as an economist in the financial industry. And Derek, I want to thank you for taking your time out of your busy schedule to join us here today.
My pleasure, Tim. Nice to be with you.
We have a lot to talk about. The pandemic and its subsequent economic fallout was not how many Canadians or businesses imagined 2020 going, and we're starting to see a bit of a recovery across the board with some sectors. What trends are you focused on as we start to rebuild our economy?
Well, some of the key trends I'm looking at, certainly the labor markets. They took just an unprecedented hit, as have activity indicators in general. I've been heartened at what I've seen. We figure April was a low for economic activity and for employment. Since then, we've seen more like a V-shaped bounce than we had envisaged a month or two ago. So the rebound has been more heroic than we had anticipated. At the same time, we know there's still a lot of headwinds as we head into the fall. And I imagine progress from here is going to get a lot more difficult. But again, I would say that the starting point as we enter the fall is a little firmer than we had expected in light of, just as you point out, just dramatic events in recent months.
Are there particular industries that you're watching more closely, and if so, why those?
Well, it's key because it's been such an uneven recovery. Overall, I've been heartened, but you can really sort out industries in a few different camps. We've had a number of what I would call industries that have just been recovering very, very sharply. I'm thinking of those industries that weren't hit as hard by the pandemic, whether it's some of the food industry, some of the sectors that have benefited from the shift in digital technologies and some of the knock-on effects. They're all recovered very strongly. At the other end, a lot of service industries that what I call sort of high-touch industries that suffered the most because of the restrictions. They've been very slow to come back. Restrictions have been lifted, but there are still restrictions in place. What we're seeing more recently is some of the fast growers have been beginning to slow down a bit as we enter the fall. Some of the lower industries that have struggled continue to improve, but at a very slow rate. And I think as we net it out, it's going to be a bit of a tough grind, I think, as we enter the fall. I think some of the early returns, easier returns from the rebound stage are beginning to diminish, and that's very natural. And then you get into, okay, what's going to drive growth going forward? And outside of housing, which is still what I consider to be just growing heroically. I mean, that's been a big surprise. Auto sales, some of the big ticket consumer goods. It's going to be a tough grind as we head through the fourth quarter. So the view is growth will dissipate and we get into something that's more normal, but at a time when activity levels are still far too low.
I don't want to put you on the spot, but housing would be something that as a non-economist was very surprising to me, looking at the housing numbers, the number of properties for sale, the numbers selling, and in fact, I think I saw one stat that housing time on market is much reduced. All of those things would be counterintuitive to me. What's fueling that, and is that sustainable?
Well, just to give you a sense, we saw housing did get hit a little bit at the start of the pandemic. Effectively, the market was shut down. So the numbers didn't really mean much. There was really no market. during March and early April. But as you say, the shock has been since the second half of April, where we've seen just enormous springback. And to give you a sense of the strength, Canadian average home prices grew by about 25% quarter over quarter in the second quarter. And that's almost 100% annualized. I mean, just the numbers are distorted in general, but that gives you a sense that this kind of trend isn't sustainable. I think we're trying to sort it out as analysts. It has been a surprise. Typically, variables like unemployment rate drive underlying housing activity. But during this unprecedented COVID crisis, unemployment doesn't seem to hold its same predictive power. You got to look at income trends. And with a lot of government underlying supports, that's helped to some of these temporary emergency supports tended to kind of patch over some of the stress on incomes and actually kept incomes growing. I'd say the bigger drivers of housing have been the fact that interest rates have gone down further. You can get a 5-year mortgage now for under 2%. And a lot of the Ontarians or the Canadians that buy homes, they have been less affected by COVID. COVID has hit harder some of the lower paying industries that have a lot of renters. In terms of home ownership, they've been hit less hard. So very uneven impact from the pandemic. So I think the two together have just led for another way, but it isn't sustainable. Some of it's pent up demand. I think it'll dissipate. But at the same time, even if we get a bit of calming to a more normal trend, it's still a market that's going to remain a lot stronger than we would have thought a couple of months ago, because rates are going to remain low. I don't see any upward pressure on rates anytime soon.
It's interesting to me, too, to think a little bit about the shift of where people will live. And I read an article recently about people that have been working from home since March now realize maybe they can work from home 3 days a week and commute 2. Therefore, there's no reason for them not to live out in Oakville, Burlington, Hamilton that way. So there's a shift almost in where people want to live or feel they need to live based on their working situation.
And I think you touched on a very important driver. This is another driver, I think, that among a longer list of drivers has been providing some of that underlying support to home prices. We tend to look at an average price. And I think with COVID, the big drive to sort of ground-based dwellings, single attached, a lot of it in the outlying areas, including Oakville and even beyond. Some of the strongest markets are outside of the Toronto area in Ontario. And I think you hit the nail on the head. I think some of this shift is driving activity. The downtown condo market in Toronto is not faring nearly as well. It's not struggling, but it's going to face some headwinds going forward, particularly as we enter the fourth quarter, and some of the mortgage deferrals that were granted, the 6-month deferrals, they expire. Some investors may be forced to list condos, a lot of them held by investors. But the single and semi-detached market, I see only limited slowing going forward. I think it's just a market that's not going to continue to grow at the same pace it has. But so there's a real dichotomy there. I think we'll have some staying power. Eventually, I'll see some settling down. I don't think the shift to suburbanization is going to continue to go, indefinitely. You'll get a bit of a slowing down, but there is a bit of a lasting impact from COVID, I think, that will drive some of these trends going forward.
A minute ago, you used the word unprecedented. We love that word on this show. I think we use it every episode. And certainly with the situation being unprecedented, the fiscal measures that have been put in place by the government have obviously increased our debt. And does that increased national debt, does that concern you?
Yeah, it's concerning. I mean, it's never an uncomfortable thing it's amazing when 5 years ago, a $5 billion program would have raised eyebrows. Now that seems almost inconsequential compared to the huge spending programs that have been undertaken. I mean, the bottom line is, I think nobody was prepared for a pandemic this year. And I think governments were forced into dramatic action just to try and fight against it. I think that was one of the challenges. It's going to leave a lasting hangover. I mean, federally, $400 billion deficit is probably what we're looking at this year. It's going to mean, a jump in the federal debt of at least 20 percentage points on a trend basis. It's still relatively low compared to countries like the United States, but the provincial debt is, of course, another aspect there where provincially a lot of debt is held. And, provinces like Ontario are also seeing huge increases, which on top of federal leaves you in a dramatically less positive position as we face. So, yeah, I mean, you got to be somewhat concerned about where all this is going to end. I think we'll get, from the speech from the throne certainly will indicate, some of the government priorities in the months ahead. It has. And, I think what it suggests is the government's right now in a bit of transition where it's going to keep some supports growing, but certainly recognizing that it can't continue to prime the pump as rapidly as it's been, and certainly lip service to the notion to kind of contain the debt going forward. But one thing I will say is with interest rates as low as they are, the debt service costs still remain quite manageable. That's one good thing. But I think bottom line, governments have to address this. I want to see roadmaps going forward of, more than a year of how governments plan to tackle this. We need a fiscal anchor. We need something that will provide some assurance that this sort of situation is going to be addressed. The one thing is, Ontario, Canada is not alone. In the U.S., particularly if the Democrats win power and we see a blue wave across Congress, the U.S. is going to see even higher deficits down the road and much higher taxes. So I think we need to keep our relative position in mind as we go forward. It's maybe not as bad as some may fear, but I am concerned about it, just to square the circle.
We're zipping through our time here very quickly, so I don't want to delay too long, but I do want to get your thought on the notion that the debt is perhaps less of a concern as the economy expands and becomes a smaller percentage of GDP. And certainly there's the school of thought out there that, yes, obviously it's a concern, but it's not the greatest concern. It is something that's manageable based on the economy expanding over time.
Yeah, and I do agree. I think a lot of economists are on the page that to the extent government's got to spend more, it's got to be used for productive reasons. If you can increase the denominator of the debt to GDP equation, that softens the blow. Which is in theory is great. I think we're still left wondering a bit how one creates that productivity. Some of the ideas being bandied about are to government have a tax credit for investment in machinery and equipment going forward, absorb some of the costs as we move into a shift of hopefully an innovative shift with a lot of shift towards digital technologies, but that might incite more investment, but it can be a very costly program. So how you balance this notion of driving growth with not spending too much money, that's going to be the ultimate challenge. But it's going to mean letting a lot of these programs exhaust that maybe aren't as productive and more targeted support.
It's going to be an interesting fall. You're watching Conversations, a production of the Oakville Chamber of Commerce, and our guest today is Derek Burleton, Vice President and Deputy Chief Economist for the TD Bank Group. I want to talk a little bit about the Canadian dollar and how it has fared during the pandemic and what we as a business community, how we react to those fluctuations.
Yeah, it's, I've been surprised. We haven't seen as big a swings in the currency as we've gone through historically. The Canadian dollar, I think in the last few years has been somewhat more stable. Now, that's not saying we haven't seen some movement. I think with the US dollar having pulled back broadly on foreign exchange markets in the last couple of months, Canadian dollar has gone up to the high end of its recent range of 76, 77 US cents. It's at a time where a lower currency can provide an added support to recovery. But I think from an economist perspective, I think just the relative stability of the Canadian dollar, again, when I've seen the currency go between 63 and more than parity and on a 10-year basis, the fact it's been moving between sort of 72 and 77 is historically not massive. But my view is that I would expect the currency to lose some ground in the near term. I think the US dollar has probably been oversold. So I think we will see a pullback. But at the same time, over the next few years, a dollar could be nearing 80 cents. So I think, that's probably a good bet. That's more in line with our view on sort of a longer term equilibrium for the currency. But just so many factors are uncertain, monetary policy differences between countries, a lot of question marks about how Canada is going to manage monetary policy relative to the Fed if conditions do diverge a bit, and that could happen. I think some of the differing challenges cross-border doesn't mean to say both countries have to at some point raise interest rates at the same pace. That said, that's probably a few years off down the road.
How's Canada doing compared to the States as far as its labor market recovery?
Yeah, I've been heartened on that front. Early on, Canada was hit harder by the pandemic. I think tougher restrictions were put in place, lockdowns, as we moved through March and April. More recently, we've seen an easing in restrictions in Canada, whereas some of the southern US states have had to impose some restrictions as their case counts have gone up. And so I think that's provided a bit of a growth advantage to Canada as we enter the third quarter. We're looking at a much bigger pop in Canadian economic activity in the third quarter, and labor markets are showing that. We've now seen about 2/3 of Canadian jobs lost during the March-April period being recouped, whereas the US is down closer to 50%. And so, that's I think, again, reflects the fact that the momentum as the easing of restrictions are lifted. It's just going to be very interesting to see as we move into the fall, and a second wave looks to be before us. Are we able to manage the case counts without any kind of widespread lockdowns? And I think we will. I think the message we're getting from governments in Canada are that it's going to be more targeted this time around. And I think just the fact that masks are being worn and the like, I think that's going to limit some of the upside. And hopefully we get a vaccine. I think our assumption is by the second half of next year, we should have a vaccine in place that's fairly widely distributed. And so that's our underlying assumption. Maybe it happens a touch sooner, but I'm comfortable with that.
Long-term look then on the third of those that are still unemployed that haven't been recouped yet. At what point can we expect to maybe get back to the pre-pandemic levels of unemployment in Canada?
Yeah, it's going to take a while. We've got unemployment rate, in Canada, it's around 10%. And this is one area where the U.S. has seen a bigger pullback. Their unemployment rate fell dramatically in the last count, down to about 8.5%. So there's a bit of a gap there. There are some measurement differences that would narrow that gap, but still the U.S. has leapfrogged us. Canada's labor supply tends to be stronger. We tend to have stronger population growth. That's one factor that's going to sustain that unemployment rate up. But I think as you cut it, and I mentioned kind of the tougher grind, I think that last third of job recoup is going to be tougher than the first 2/3. And so that's going to probably take the better part of a year or even longer to recoup. It's going to mean the unemployment rate is going to kind of come down, but very slowly. And we don't have the unemployment rate recovering to its pre-pandemic level right through our two-year forecast horizon. So it's going to be a challenge. I think, what the federal government's put in place are some transition programs to help mitigate the fact that the CERB emergency benefit is no longer in place. We're transitioning in Canada to an expanded EI program, some other new programs to support gig workers and the like. And I think that transition support is going to help. It comes at a steep price tag, but I think it's important to help some of these unemployed transition back to the workforce, which is going to take a number of years. And even then you've got skills issues and the like to address. So a grind, that's all I can say on that front.
So as we talk about the economic recovery, and I read something recently that Canadian household debt is actually declining for the first time in a long time, but are Canadians spending their dollars? I look around my neighborhood, everybody's renovating something. What trends are you seeing in Canadian household spending?
It's been more V-shaped than I would have ever imagined. We're now, whereas a lot of sectors are still struggling, manufacturing is still well below its pre-pandemic levels. Consumer spending indicators have really popped up and now are above pre-pandemic levels. A lot of that spending, of course, has been reallocated, shifted, because going out to movies certainly isn't where people are spending their money. It's on renos, it's on different food types. It's on things that you do at home essentially. So that phenomenal rebound. I think we did see a pullback in the debt to income ratio, a dramatic one. Keep in mind that, with all the emergency supports, I think there was almost a surplus of cash being distributed. which, governments could argue they went hard at it to try and cushion the blow. And the savings rates surged, even with the spending increase. So that higher savings, I think, is going to help a lot of households as the period of mortgage forbearance ends, loan forbearance. We start to see a shift away from that because market incomes are still quite soft. So the sustainability of consumer spending, much like the economy, is going to be more in question as we head into the fourth quarter, just given some of the easing and supports. But no, I still see the outlook being okay. It's just, yeah, I mean, it's been an unsustainably strong rebound that I don't think that will continue in the coming months.
You touched on a vaccine a moment ago and talking about maybe late into 2021. Is that factored into your economic outlook, or what changes will that bring to the economic outlook?
Yeah, it is. We do have a bit of a pop in growth in the second half of last year. So to give you a sense, if you're looking at the profile, growth will slow to a fairly modest rate in the fourth quarter and into the first half of next year, as you have these cross currents in the economy. Still recovery, but a fairly modest recovery. And then once we get a vaccine in place, it should set the stage for a bigger pop in some of the areas that have been so deeply affected by social distancing and restrictions. And that should help the second half of next year. So our view on 2022 is actually quite positive given some of the momentum. Now, I realize that nobody can predict the exact timing of a vaccine, but I think just given some of the indicators, I think the second half of next year looks pretty reasonable for that assumption that, you get quite widespread distribution of a vaccine, but it is embedded formally in our forecast.
And the timing is one thing, and the efficacy will be the other.
Yeah, it's a lot of questions, whether the number of doses, how widely it's distributed, first focused on certain more vulnerable areas. Governments, do they, mandate it? These are all questions that I think are left unanswered. I think what we do assume is that, there will be some vaccine that's available and will be used enough that it's going to help the economy. It's going to reduce some of the uncertainty, and we'll get back to somewhat of a more normal life, even if we don't have 100%. Vaccination across the population, that will have a sufficient number to provide that boost in confidence and growth.
Just a couple minutes left, Derek, but I wanted to get your thoughts. The vaccine and its efficacy is what keeps me up at night. As an economist, what keeps you up at night?
It's still, COVID, obviously, that we still have a bit of an uncertain path of COVID heading into the second half of this year. There is the potential for a double dip recession. If, and I think to get that, I think you'd have to have financial markets that have been rallying very strongly across most asset groups, not just housing prices, but, equity markets, even low bond yields reflect high bond prices, big rallies. And that financial impetus has helped the underlying recovery. You could get a quick turning in that. I don't know what would trigger it. It could be COVID, could be the upcoming U.S. election, fears of, no declared winner from the election, some of the legal issues that have been bandied about that, we'll have to wait and see. But markets can swing very violently, and that with the COVID second wave could potentially drive a what we call a W pattern recovery, where you get a double dip. That would not be constructive at this stage. So I think those are some of the things. And the election, of course, in stateside, I think that's going to be very interesting to see how that unfolds.
Yeah, I agree. And probably for the first time, maybe ever, we won't have results likely on election night due to the counting of mail-in voting and all of that. And I'm sure that's going to be a wonderfully smooth time in American politics. So let's talk more on a positive note. What as an economist, gives you reason to be optimistic?
Yeah, I think Canada, some of the things that keep me optimistic, talked about some of the things I worry about, government debt and the like, longer term. I think there's real innovative potential. And, I think part of it is driven by governments, but it's going to be very interesting to see a lot of the trends in terms of innovative shift to digital that were in place ahead of the pandemic are just going to be accelerated by the pandemic. I know that search for a COVID vaccine is probably absorbing a lot of the global innovative capital at the moment, but not all of it. And there is a lot of positive shifts there that I think it'll be interesting to see how that factors into some of the data. Do we get that productivity boost down the road? Do we see it visibly show up? And I wouldn't be surprised if we do. We're seeing such a dramatic shift in the use of some of these technologies. So that's something I look forward to. I think along with that, I think Canada's still a very attractive place to move to. I think once some of the dust settles from the pandemic, we will remain a very positive place to attract skills from around the world. The U.S. is facing so many challenges still, and likely to, that Canada will still look like a relatively place to invest and to move to. So I think some of the demographic trends will be positive as well. So those are just a few things that I'm hopeful about.
Well, that's a good list. That's all the time we have today, Derek. I want to thank you for joining us. It was a pleasure speaking with you, and hopefully we can do this again sometime.
My pleasure. Thank you, Tim.
Great information. Thank you for watching at home. We would very much love your feedback. If you have ideas for guests for this season, please let us know by dropping us a line in the comments section or emailing us at info@oakvillechamber.com. That address again is info@oakvillechamber.com. We're back next week at the same time with our guest, Mark Majewski. We'll be looking at a lot of ways that data will be informing our future economy and some of the threats to that around issues such as 5G. Thanks again, and have a safe and productive day.